Taher Badshah joins us, Chief Investment Officer with Invesco Mutual Funds. Let's get his market view going. Taher, too soon, too quick, or the bulls are back and they're here to stay?
Yeah, I mean, it's been a pretty fast and furious kind of a rally. I mean, we didn't really expect it to make a comeback so quickly, although we were reasonably constructive a couple of months ago. But some part of it obviously has now looking like having played out, and everything is not fully behind us in terms of the challenges that we had a couple of months ago. I think some of these can always come back on the table, whether it be inflation, whether it be even for example, commodity prices have actually kind of begun to threaten a little bit once again, whether it is metal prices for one. Oil has always been a laggard, I mean, both in the fall as well as in the rise. So I think it could probably follow, So we feel that, and then valuations, which were arguably at least at some nominal discount to the long-term averages, at least for India, have crept back to a little above averages, at least a 5-year average for that matter. So, and well above the 10-year average also. So to that extent, I think, this is a market which now is open to risk. I mean, maybe a couple of months ago, we had relatively lesser downside, but risk reward is relatively more balanced at this stage, and all the risks potentially are not behind us.
Sona BLW, let's just bring up that stock up as well and show you where it's currently at. It's dragged about 5.5%, 16% equity has changed hands. Remember, we told you this yesterday that Blackstone would have exited, although they own, I think, around 30% in Sona BLW. So it's not a complete exit. They still are very much investor in Sona Comstar, but that of course is a function of the block deal that you're currently seeing in trade, and which is why that big reaction coming in. But Taher, one intriguing trend that one has seen with the market is that each time that you've actually seen a rebound, and this is, from the start of 2020 to now, in this short span as well, the market has had newer leadership each time. In the last recovery, it started off with autos and now being led by financials. Just wanted to understand which are the spaces where you see continuous leadership quality, and where would you say, the time has come to profit take, or at least take partial chips off the table?
So clearly, there has been different sectors which have been assuming leadership, and that has been the scenario almost for the last 12 months. We've seen a fair bit of sector rotation. But the leadership is also very quick to change. I mean, it's not something which is a 2-3 year phenomenon. It works out for 6 months and then the market moves on to something else. I think at the beginning of the year, at least in our minds, we were carrying this impression that it is better to stick to some of the domestic stories versus the global counterparts, and at some level also preference for India-specific sectors which actually did not do well in the last couple of years. And clearly that is what has actually kind of rebounded back, whether it is some pockets of consumption, banking, which has been a reasonably strong, big laggard of the last 2 years, 2020 and 2021 in particular. So, and then industrials, which again is a India-facing, largely India-facing sector. So to that extent, I think we've seen that move. Now, on the other hand, some of the global sectors also, after the fairly severe underperformance, whether it be technology at one level and maybe even metal commodities, some oil and gas commodities, seem to have gone into a bit of that value pocket. So my sense is that that side is now very materially ignored. I mean, I don't really think there are immediate triggers, but clearly value strategies wherein we have a play, we are somewhat inclined to gradually nibble into some of those spaces which have not done well as part of the general rotational feature which has been around in the market for some time. So I think sectors like technology, commodities, to some extent, we don't have a foolproof case here at this stage. Global data is still pretty mixed, but I think you can make a value case, and if you have a somewhat longer horizon, maybe ranging from 12 to 18 odd months, I think those sectors can. Meanwhile, on the other hand, some of the domestic sectors which have done well could have some more momentum. They've done well very, very quickly in a very short period of time. They've delivered 20, 30, 40% kind of moves. They should continue for a while, at least into the busy season over the next 4 to 6 months. But I think somewhere you will find an opportunity to reverse the trade.
Good morning. So, just sticking with this, while you're hunting for the technology names that you would like to add for your portfolio, things have really changed, right, since end June, the way the markets have moved up. The trend beginning in July, 2,000 point plus rally. We're waiting for the small caps and the mid caps to play catch up with the frontline indices. But can I ask you, in that time, what kind of, did you make any big changes to your portfolio? Any names that you added?
You mean in the technology sector particularly? I'm sorry, I don't know whether I got it
Across.
right.
Some of the big ideas that you had and you executed.
So, like as I said, I mean, we positioned ourselves for at least, it was not that India was completely isolated, but in general, we thought that India will probably be able to handle things a little better, given that, our inflation rates were still not too far away from our broad 20-year averages. And, we don't really have much to do in terms of, bringing down inflation or controlling, and in terms of the path of interest rates. So domestic appeared to be a better picture, and therefore overall concentration was on sectors like, as I said, financials, which had underperformed, consumption-related names, consumer discretionary, autos in particular was a very important piece. We faced a struggle, especially during the first 2 months of this year with this strategy because of the Russia-Ukraine breakout, and in which we saw a further surge in commodity prices. But that has more than reversed in the last 4 to 5 months, and despite that short hiccup, we were able to kind of justify our positioning that we took at the early part of the year. And I think, like as I said, I mean, going forward, we might probably once again visit an inflection point where we might have to think of reversing that trade as well, because by which time, if we get some more comfort on the global stories, and U.S., China both seem to suggest a very mixed picture as far as the economic behavior is concerned. There is a consolation as far as inflation is concerned in U.S. in particular, but Eurozone and China are still not fully out of trouble, and to that extent, it's not immediately clear. But I think that picture will unfold in the next 4 to 6 months. So, like as I said, there will come an opportunity where we might have to reverse that trade and then start looking more at the global names and at the expense of some of the domestic stories.
Okay, so you may reverse that strategy later, look for more global names as well. But since you brought up auto, I want to ask you one question, and that is, in your top holdings, you do have Maruti Suzuki. Year to date, I think it's given a return of 10% plus. You weren't tempted to also add an M&M, which is up 50% year to date, the new darling of the stock market, so much buzz around it?
Bit of exposure to M&M as well. In fact, in our value strategy, actually, we have M&M at a higher level in terms of our weightage compared to Maruti. I mean, we've been, at least in our value strategies, we have reflected our auto exposures very well across most of the four-wheelers, whether it be tractors or cars or commercial vehicles for that matter. So I think we are very much there, and that's clearly come to our aid in the last some time. So I think, see, I mean, different companies or different stocks have different phases, but I think in general the intensity of recovery is visible in the passenger car market and in the CV market, and I think this is a trend which is still likely to continue. Maybe stock prices have reflected that quite early, but that's how it is. I mean, markets are always ahead. But the comfort is that the next 4 quarters or so, at least many of these companies have their ability to show decent numbers. You will probably have a kick coming from reversal in commodity prices, expansion in margins, top line obviously coming through, so I think you're not going to be very perturbed, or you're not going to face the issue of numbers not flowing through, and they are all now seeing a fairly healthy demand picture, as we all know. So I think each of these companies still look decent for some more upside, but like I said, I mean, at some time we have to think through as to what is priced in.
Great to have you on show. Thank you as always for taking the time out and speaking with us.